All right, the big picture is simple. Macro headwinds are creating broad market pressure, but specific catalysts are still driving action. Here's how I'm looking at the next 1 to 2 weeks. 21. That's how many days the US government has now been shut down. We're talking the second longest in history, and it's a direct drag on the economy. So, we're going to break this down into 4 parts. First, the major headwinds. Second, where the capital's actually flowing. Then, we'll map out 3 clear market scenarios. And we'll finish with specific risk-defined option setups. Let's start with the macro risks. Right now, it's a mix of domestic political chaos and international pressure that's really driving all this uncertainty. The number one domestic risk is this government shutdown, already at day 21. Some projections are now floating a 40-day duration. This is a real drag on GDP, and with negotiations stalled over ACA subsidies, there is no clear end in sight. Now looking externally, the pressure is also building. US-China tensions are heating up again with new threats of software export controls. The US is also planning what they're calling a substantial increase in sanctions on Russia. But the most immediate catalyst, that's the upcoming CPI report. Okay, this timeline shows you exactly when to be watching. The big one, the main event, is this Friday at 8:30 a.m. Eastern, the CPI inflation data. Consensus is sitting at 3.1% year over year. You can bet any deviation from that number is going to move the market. Also on the radar, that tentative US-China meeting in late October, and of course, any headlines on the shutdown. So with all this pressure, where's the money actually moving? Because we're seeing a major divergence right now. And this really shows you the split in the market. On one hand, you've got the broad market, SPY, getting slapped down at that 672 resistance zone over and over. But on the other hand, you see these pockets of real action. The energy sector is showing strength on the back of those pending Russia sanctions, and quantum computing stocks are moving, but that's on pure speculation. And what's feeding into that broad market weakness? Well, look at recent earnings from some of the big growth names. Tesla missed on EPS, which triggered after-hours selling. And Netflix? It dropped a full 10% after its report. When these major stocks stumble, it puts a real damper on the whole market sentiment. Now, I want you to focus on this number, $13.4 million. That is the size of a single institutional bet placed against a critical company that's right in the middle of this geopolitical storm. So where did that bet go? Taiwan Semiconductor, TSM. Somebody bought $13.4 million worth of bearish in-the-money puts. The thesis here is not complicated. It's a bet on downside driven by those US-China tensions over Taiwan. For us, the key takeaway is the technical level we need to watch. That support right around $284. And then you have the complete opposite end of the spectrum, total speculation in quantum stocks like IonQ and RGTI. The so-called catalyst is an unconfirmed rumor that a future government administration might take direct stakes in these companies. Let me be perfectly clear. This is a high-risk, rumor-driven move. It's not based on fundamentals, and it could completely evaporate in an instant. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
Okay, let's put all this together and map out 3 potential paths for the market from here.
And everything hinges on one key technical level for the S&P 500. It is that resistance zone right around $672.
All right, this table breaks it down. Our base case is that these negative catalysts play out. SPY fails at 672 and then tests support down at 669.50. That implies a cautious net short delta posture. The bull case needs good news. Think a soft CPI print for SPY to break and hold above 674. That's a shift to risk on. And the bear case gets triggered by bad news, like hot inflation, causing a break below 669.50 and a test of 654. That means it's time for heavy hedges. So for the bull case to play out, we need a catalyst. What would that look like? Well, a CPI print below that 3.1% consensus would definitely help. So would any positive news out of the US-China meeting or a sudden resolution to the shutdown. The biggest risk to this thesis is simply that the macro fears are just too heavy and they continue to outweigh any good news.
On the flip side, the bear thesis gets confirmed if that CPI print comes in hot, above 3.1%, or if US-China tensions officially escalate, or if we start seeing the shutdown show up as a real drag in the economic data. Any of those could trigger a move lower. The risk here, of course, is that the market might have already priced in a lot of this negativity.
All right, last part. Let's turn this analysis into some actionable risk-defined ideas. First up, TSM looking at the bearish side. The thesis is to follow that huge institutional bet we saw. You can structure it with a long put, or to define your risk, a put debit spread. The edge here is exploiting that fear premium around US-China tensions, and your invalidation is crystal clear. If that support at 284 holds, or if the stock breaks to new highs, the thesis is wrong. Next, a potential bullish setup in energy, using the XLE ETF. The thesis is that the energy sector benefits directly when these new, substantial sanctions on Russia are announced. A call debit spread is a good way to play that with defined risk. The invalidation, if the sanctions are weak or if the market just sells the news, it's time to get out. And finally, a straight-up macro hedge using SPY. This isn't about getting rich, it's pure risk management. You're protecting your portfolio against a negative surprise from the CPI report. A put debit spread is a cost-effective way to buy that protection. The hedge is invalidated, and you know it's not needed if the market breaks out with conviction above that 674 resistance level. Not trading advice, just a market update to keep you informed. Markets carry risk. Trade your plan, manage downside, and verify all data. So that's the setup. And it all comes down to this one question. As we head into Friday's CPI report with Washington in total gridlock, is this market priced for impending chaos? Or has it already priced in the worst, setting us all up for a surprising move to the upside?